Hello, my name is Clay Hostetter. I am a tax planning manager here at Rhame Gorrell Wealth Management. Today we are going to be covering a potentially lucrative tax strategy, the Mega Backdoor Roth conversion strategy. This strategy gives employees a way to supercharge tax-advantaged 401k savings beyond the normal IRS limits. If you or someone you know could benefit from this strategy or other services our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefit, and retirement strategy perspective. Let's jump into today's topic, the Mega Backdoor Roth conversion strategy. So what is the Mega Backdoor Roth conversion? At its core, the Mega Backdoor Roth is a strategy embedded within your 401k plan. By undertaking a series of transactions, employees can make a Roth 401k contribution beyond the normal IRS limits. For instance, in 2024, employees can contribute $23,000 either via pre-tax or Roth contributions, with a catch-up contribution of $7,500 if you are age 50 or older. The Mega Backdoor Roth allows certain employees to add tens of thousands of additional dollars beyond that limit annually to their Roth account within their 401k. I'd like to take a moment to refresh everyone's memory on how pre-tax versus Roth contributions work for tax purposes. As I previously mentioned, for 2024, employees can contribute $23,000 to the pre-tax, Roth account, or some combination of the two. Pre-tax contributions, as you may know, involve making contributions before taxes are paid. However, all of your contributions and your growth are taxed upon distribution. Roth contributions, on the other hand, are made after federal income taxes are paid, and all of your future growth and your original contributions are tax-free upon distribution. The determination of whether an employee would want to make a pre-tax versus Roth contributions is entirely dependent on their current tax rate versus their anticipated future tax rate. This is a very in-depth calculation that is different for every person and is why we suggest consulting a financial professional such as our team before coming to a final determination on what is best for your specific situation. Some 401ks provide a third account or bucket called the after-tax account. This account is what allows us to facilitate the Mega Backdoor Roth conversion strategy. Let's discuss the tax features of the after-tax account because it unfortunately combines the worst elements of both the pre-tax and the Roth account. After-tax contributions, as the name implies, are made after federal income taxes have already been paid on the funds. However, growth that occurs while in the after-tax account is taxed at ordinary income upon distribution. For the purposes of this video, let's assume an employee is making $250,000 and their company is giving them a 7% match, which comes out to $17,500 a year. Based on the example discussed above, the total going into the 401k for an individual maximizing the pre-tax contribution is $40,500, $23,000 from the employee's payroll deductions, and $17,500 from the employer's match. This $40,500 total is well below the total of what the IRS allows you to contribute to all three of these buckets, which is $69,000 for those under the age of 50 and $76,500 for those over. So where can this $28,500 difference between the IRS limit and the other maximum contributions go? You might have already guessed by now, it's the after-tax account. So you might ask yourself, why would I contribute to an account with no current tax reduction where all of my growth will eventually be taxed at ordinary income at my highest marginal tax rate? The answer is because we don't leave the funds in that after-tax account to grow indefinitely. Using this strategy, you will convert all of these after-tax funds to Roth. And the best part is that if these funds are converted to the Roth before they have time to grow, the conversion is entirely tax-free. How this works is that once you maximize your pre-tax or Roth contributions up to the IRS limit for the year, you can start putting funds into that after-tax bucket. Some 401k plans will do this automatically, while others will require you to elect this treatment for the additional contributions. Subsequently, these additional funds are converted to the Roth account, where they will enjoy tax-free growth until they are distributed in your retirement years. Again, every plan is different. Some 401ks allow multiple conversions per year, while others limit the number of conversions that can be made in a calendar year. At this point, we hope it's becoming clear that this strategy can be an absolute tax game changer for retirement savers. Let's consider a comparison of an individual who fully utilizes the Mega Backdoor Roth strategy over the course of their career versus an individual who alternatively diverts the funds into a brokerage account. Given that the Roth earnings are tax-free, while the brokerage account earnings will generally be subject to a 15 to 20% tax rate on long-term capital gains and an ordinary income tax rate of up to 37% on interest income and short-term capital gains, the differential is at a minimum several $100,000 in needless taxes paid. Before we wrap up, I'd like to draw your attention to an important consideration surrounding this strategy. If you have a pre-existing after-tax balance within your 401k or growth on recent contributions, you should be aware of the Pro-Rata Rule. The Pro-Rata Rule states that if an after-tax account contains a mixture of contributions and growth on the contributions, any conversion or distribution from that account will be partially taxable depending on the ratio of the contributions and earnings. Let's say over the course of 5 years, you contribute $150,000 to an after-tax account, and this grows to $200,000. Now, every dollar withdrawn or converted will be 25% taxable according to the amount of growth within that account. You can combat the Pro-Rata Rule by making regular conversions of the after-tax dollars before the growth can occur. If you have a pre-existing after-tax account balance that contains growth, some 401k plans provide different options to help employees clean the slate and open up this Mega Backdoor Roth conversion strategy. These 401k numbers are different for everyone, so we absolutely recommend that you discuss the effect of any current balance that you have within the after-tax account with a tax expert who can help you understand the tax implications of any future conversion. Thanks again for spending some time with us today to learn about the Mega Backdoor Roth conversion strategy. As a team, Rhame Gorrell Wealth Management serves roughly 400 families across the United States, as well as expats abroad, with roughly $1 billion in assets under advisement. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. If you'd like to meet with one of our numerous CPA, CFP, CIMA, or CFA professionals for a complimentary consultation, please reach out to us using our phone number, sending us an email, or visiting our website today. Remember, optimize your wealth, minimize your taxes. Thanks for watching.